Hi, welcome everyone. We have some people joining. Ryan will be joining us in just a few minutes, so we'll get started in about 5 minutes. Welcome everyone. Thanks for joining. We're going to start in about 4 minutes. If you can see your names joining, thank you for attending. Ryan will be joining us in a few minutes. Okay, we're going to start in just under 2 minutes. So if anyone needs to grab a coffee, now's the time. Hello from Kuwait. Got a lot of people joining. We'll be starting in a few moments. All right, welcome everyone. Thanks for joining. Without further ado, here's Ryan.
Hey, everybody, and welcome to our webinar. Thank you all so much for joining. See, we got some friends from Kuwait here. We probably got some friends around the Americas. And maybe if you're up for it, if some of you are up late, maybe some friends in Asia, we will see shortly. All right, so today we're going to talk about the Coffee Market Reports Acceleration webinar. So this webinar is really all about helping you to develop a view, to help you develop an informed view. That's really why we have Coffee Market Reports and why we deliver those. So what does this presentation look like? Well, we're going to start with a little intro here. Where I'm going to tell you a bit more about our philosophy on how to use Coffee Market Reports. And then we're going to go right into it, where we're going to start with our data reports. Those reports are really focused more on the actual numbers that represent information in the coffee world. And then we're going to go into our analysis reports, and we're going to talk about how reports are really about drawing conclusions from the data. Then we're going to wrap it all together into a nice, neat little package for you and put some conclusions together and bring it all home into what we can take away from all of this information. And then as a special gift to all of you, we have a little mystery box here at the end, and that's our surprise for you and our thank you for joining today. So we're going to conclude with our conclusion and our mystery box, and then we should have about 10 minutes at the end as well to go over questions. And so you can ask any questions you have about material that we covered, or if there's any reports that we didn't go over today that you want to learn more about or know about, we can answer some of those and talk about those in the last few minutes. Now, you may have heard that this seminar or this webinar was free, and actually we lied to you. It's not free. There is a cost. There is a cost for entering this webinar, and that cost is our 3-question survey that we are going to deliver to you at the end of the webinar. So fill that out. That's our mandatory survey. So everyone must do that or face the consequences. But please do that. We do want to hear from you. We want to get your feedback. Okay, so as I kind of alluded to on the first slide there, this is about coffee market reports, but really it's about having an informed view. So I have a good friend who is a speculator. He trades coffee, trades cotton, cocoa, sugar. He trades a lot of different commodities. He's been in around the block for quite a few years. I've known him for maybe 7 or 8 years. And he told me once, he said, Ryan, only 2 or 3 people have an actual opinion on the market. Everyone else is just repeating some version of the same opinion. Now, maybe that's a little bit harsh. Maybe that's a little bit cynical. But I think there's a lot of truth in that, because having a view is dangerous, right? Maybe your clients will be mad at you if you're bullish, or maybe your suppliers will be mad at you if you're bearish, or your friends if they have different trading positions on. So there's a lot of risk in having a view, especially if you have a boss with a different view. That's another risk there. But if you don't have a view, if you don't have an informed view, then you're essentially abdicating your decision-making process to somebody else. If you're just adopting somebody else's view, then you are outsourcing your decision-making to somebody else. Now, the key to making informed decisions is having an informed view. And data is what's going to drive our informed view. So when we take current qualitative and quantitative data and we apply that to our understanding of market dynamics, that's how we're going to have a view. That's how we're going to have an informed view. Now, the dynamics changes slowly. You see my buddy Adam Smith here. Our understanding of supply and demand and market dynamics has not changed all that much in the last 300 years, right? Ever since we first came up with the old supply and demand curve. Yes, there's new information that's added. There's new ways of thinking about the market. And the market certainly has changed, especially in the rapidity of information and the availability of information. but the overall dynamics change relatively slowly, at least compared to the data. The data changes quickly, especially in today's day and age of email and internet and satellite photos, where everybody can see the latest data all at once. So we have to follow the data to keep our view current. And our reports are going to present the data. So that's how we're going to be able to consume the data and integrate it into our internal worldview. So who are we and why are we talking about coffee market reports? Well, we're the Coffee Trading Academy here. Maybe you've heard of us. We have a dual mandate. We offer high quality training on the one hand and research on the other, but we're focused exclusively on the global coffee market. Coffee market reports are really our bread and butter. And so that's why we are weirdly passionate and excited to talk about coffee market reports with everybody. So we distribute reports and we believe that they should be data focused. They should provide relevant context to that data. And when we offer analysis, when we provide analysis, it should be consistent and transparent. And that's really the important way to do analysis. Now, you might have noticed my mascot here, Joe. He's a coffee ninja, as you do. We also believe that fun is important, and that's why we have all of our cartoons and bright colors and easy to read charts and reports and such. And that's not just to get a laugh out of you. That's just not to be just fun and cute. It's actually has a very practical reason, which is that if your reports and your webinars and your information is too boring, no one is going to look at it. So if you want your staff, if you want your team to be well informed, you have to have a way of making that material engaging to them. And so that's something that we really try to focus on when we communicate information through our reports. We also do training. We have a coffee traders course coming up in April. Feel free to check that out if that's of interest to you. Now, this is important. We have additional resources available for all of you. This is all free. We have videos and podcasts you can check out where we talk about market dynamics, where we talk about the coffee market in particular. We talk about how to understand reports. We cover current events, things that are going on in the market. If you receive any of our reports, we always have links to further information on how to consume that report, and then a little bit of information on commodity analysis and just general trading. So that's us. You can find that on our website at coffeetradingacademy.com. Now, in this presentation, we're going to cover several key reports that are essential for us to understand as coffee traders or roasters or producers. And we're going to divide them into two categories here. So we've got our data reports, which is going to focus on the actual numbers that represent real world phenomenon in our coffee market. And then we also have analysis reports. And analysis reports are really about drawing conclusions from that data. So the data reports we're going to look at today are the certified stock reports, destination stock reports, and the COT. And then in our analysis report, we're going to look at our market report and how we draw conclusions about the market and try to using the data. But enough about us. We want to hear about you. So who are you? Are you a roaster? Are you a trader? Are you a speculator or a financial services provider? Are you a producer? And what are you hoping to achieve out of this course or this webinar? What are your goals? So we've got a little poll here. So we want to see who our friends are here. It's just a couple of questions. We're going to take about, I don't know, what do you think? 15 seconds here, 20 seconds to fill out this poll. And let's see who we're talking to. I don't know if you can tell here, but this is a guy who's hedging. See, it's a hedge. Yeah. I promise dad jokes and I deliver. All right. All right, let's see what our results are here. Everyone have a chance to fill that out? Okay. Okay. So it looks like we have a interesting mix of basically roasters and importers. A lot of roasters and importers, so the trade is well represented here, and also some producers. Awesome. We got some of our friends here in the growing space. And then we have one person here who's just here for the dad jokes. That's awesome. Okay. And yeah, we're all over today. in US, Latin America, Asia, and Europe. Okay. All right, so that's who you are, and that's good. And I'm glad you're here for general coffee knowledge, because that is what we're going to deliver, as well as some specifics about the reports. So we want to be goal-oriented when we consume our reports. We're going to have 3 core goals whenever we look at a report for the purposes of understanding the coffee market. Number 1 is, what is the key data or conclusions from that report? If it's a data report, then we're looking for certain key numbers. We're going to highlight some of those for you. And if it's an analysis report, we want to focus first of all on the conclusion. So is this information, is this report important for me to look at? Yes, then here's the information I want to pull out of it. 2, we're going to be updating our internal mental worldview here. Now, this is different from a market view, right? It's not saying like, oh, I'm bullish or I'm bearish. Instead, all of us, if we are active in the market here, if we are focused on the coffee market on a daily basis, we're going to have a mental model of different phenomenon throughout the coffee world. Okay, so what are the stock levels in Europe? What are the differentials in Brazil, right? That's a big deal right now, those of you who are following that. What is the currency exchange rates? Now, you might have different understandings of market dynamics about how these interact with each other, but we need to generally update this information mentally so that we can then draw conclusions from the data. And then finally, we want to be efficient in our use of time. So one of our core goals when we open these reports, when we consume the reports, is being efficient. So how do we be efficient when we consume reports? Well, first of all, we're going to consume them hierarchically, okay? So we want to start with a top level view, say, okay, what is the conclusion of this report? Or what's the key data that's in this report? If that's useful, then or if that's relevant to something that we want to learn more about, we can then dig deeper through the subject lines and summaries to find that information more quickly and to organize the different reasoning and logic behind the conclusions. Headers and graphs can also provide context and visual clues as to what the information is that we're looking for. One thing we include in all of our reports is a table of contents, and that's so that you can more quickly find the information that's useful for you or relevant to you, and you can then dig deeper directly into that particular topic. All right, so that's our little introduction. Joe, why don't you check that off for us? All right, thank you, Joe. All right, so now we're going to move on to data reports. So data is going to form the core of our informed opinion. When we look at a report, it should present us the data, but also some context. The context is also very important. The data is the numbers. So that's the actual millions of bags that we're looking for in the GCA stocks, for example. The context is going to help us to understand that data, but it's not the data itself. So that might be the average, the relationship to past years. Charts are visual context for us to consume. But we want to prioritize the data. That's the real information that we're going to be downloading into our internal model of the world. Now, when we look at stock reports, and we're going to look at a few different kinds of stock reports today, these have a very important purpose. Now, let's turn the question to you all. I know we have some experienced people here as well, in addition to more junior people. Why are stocks important? Why are coffee market stocks important? If you think you know the answer to that, then go ahead and put that in the chat. I want to hear what some of our more experienced members say. Why are stocks important to understanding of coffee? Now, if you're newer and you don't know the answer, that's totally fine. I'm gonna give you my view on it in a second, but we want to hear what you guys have to say. Now, when we talk about stocks, this is green coffee, right? Once that coffee is roasted, it's considered consumed. It's no longer something that's tradable and easily store as well. So we're talking about storage of green coffee here. Now, stocks we can divide into 3 basic categories. We have destination stocks, we have origin stocks, and we have certified stocks. Now, the main difference between destination and origin stocks is obviously where they are located. So destination stocks are countries that does not grow coffee, and origin stocks is where that coffee originates from, right? It's from countries that do grow it. And then we have certified stocks, which is a particularly special and important kind of stock that we're going to look at in just a second here. All right, so why are these stocks important? Igor, what did we find out?
We have some good answers here. Someone said security of available supply, market structure. Tim said surplus, deficit sets price. I think he's the closest one we have. And Gus said stocks are important for understanding availability and replacement values. I think what you're looking for, Ryan, is that ultimately stocks affect prices.
Yeah, absolutely. Those are some great answers, though. Availability of supply is really key. And that is going to connect very closely to price. So we care about stocks, if for nothing else. And, you know, if you're a roaster, maybe you care about stocks because you need to make sure that coffee is available to roast, right? It's part of your business. But we care about stocks because it's going to influence price. Stocks is the supply and demand, which I think someone else kind of mentioned here. Now, the key relationship here is that there is an inverse relationship between stock and price. So when stocks are rising and high, prices are low, right? There's a lot of supply available. When stocks are declining and very low, as we saw recently, prices are high, right? So when we create price models, and you'll see that in some of our analysis reports, stocks are the key data for our price model. Now we've got destination stocks and we've got the certified stocks. If you want to find this data yourself, there's several different organizations that supply it. So we have the GCA in the US, that's the Green Coffee Association, they report stocks. We have the European Coffee Federation, they report European stocks. And then we have the AJCA, the All Japanese Coffee Association, and they're also reporting stocks. So if you download it from their website, this is what the GCA stock report looks like. It's reported in bags, and you can see here we have 2 months of data, right? The most recent month and the prior month, so we can tell the difference. That's good. And then we also have the ports where that inventory is located. And this comes out monthly, like clockwork on the 15th of the month, usually around 3:30 p.m. Then we have the ECF stocks. So the European stocks has been changing over the years, but their report looks like this. It's a PDF. It's actually a little bit longer than this. I didn't include all of the pages here, but they report in metric tons, right? The US, we still haven't really gotten on with the metric system yet. We're still messing around with bags and pounds. But in Europe, they have metric tons and they have multiple years of data here. They also provide some interesting granularity because they divide their stock report into milds, naturals, and robustas. This comes out bi-monthly. It's a little bit shaky on when exactly that comes out because they do rely on the reporting, voluntary reporting to produce this report, but they've gotten a lot better about getting this out of a timely fashion, and it's usually about every 2 months. Now, then we also have the JCA, the Japanese All Japanese Coffee Association inventory report, also in metric tons, and they have a year-to-date format here. They don't show the type of coffee, but they do show the origin, so we can kind of imply some of the types out of that, and they also show the port. Now, what we do is a service for our subscribers. This is free for anybody who wants it. We take all of that information and we put it into a consistent format so you can apply consistent analysis across any of these different reports. So this is how you would read those reports if you receive one. Number one, we want to focus on the data first. So the top portion here shows the data, okay? So if we look at the most recent GCA stock report came out in December. So that was 6.38 million bags. So that's the information that we are going to download, that we're going to internalize, is the actual absolute number. But then we want to get some perspective, right? We want to see what it was last year. You can see it was up on last year. We want to see it versus the average and the min-max, et cetera. Now, one quick note here is that we have that 5-year average and the average. Now, these are important for different reasons. generally speaking, if we want to find out information about, we want to find context, we want to use the longest period possible. So if there's 10, 15, 20 years of data, then that average would be a good way of finding the arithmetic mean. That would give us some information about that. However, population has been increasing every year, and consumption has been increasing with population. So actually, the average, the long-term average, is actually going to be much lower than is particularly relevant to provide context to these stocks. So we can show a 5-year average as well, and that will help to show, okay, of the current stocks that are available, is that a lot or a little by recent standards? Okay. The longer term average might give us a better picture of the seasonality, perhaps, but the 5-year average is going to be better for context because that's going to have numbers that are more immediately relevant. Then the second portion here shows month on month and year on year changes. The year on year is going to be more important for us because that's going to be comparing, it's going to be taking out seasonality essentially. So we can see our stocks increasing or decreasing. The month on month is going to be good for knowing about the momentum, especially when we put that into context. So let's look at some of the context here. One thing you'll notice, we've got a 5-year chart and a 6-month chart here, is that the inventory levels have these humps, right? They've got these sort of bumps in the middle here. And why is that? That's because coffee is grown according to seasons, right? So we get a whole bunch of origins are harvesting coffee all at once. And so we receive dumps of coffee in destination that create these bumps in our inventory levels. Then we draw down as we wait for the next harvest, and then we build them back up. So if we overlay those inventory levels over one over another, we can get a better, more clear picture about what's actually happening with inventory. So here you can see this black line here shows the general seasonality according to the average levels. And then this black and red ninja line here in the middle, that represents what the last year's inventory levels were. So we can draw some conclusions by looking at this context here. We can say, okay, during a period when typically the market draws down inventory levels, we actually had inventory move sideways. So even though looking at just the numbers itself, it might look like, hey, the month-on-month change is kind of close to zero, not a lot's happening in inventory. What that actually means is kind of bearish, right? It means that, hey, when stocks typically are drawing down, they're barely drawing down at all. So we might draw some conclusions about demand, for example. Now, the certified stocks are a special case of inventory. Certified stocks are special because they can be exchanged for a futures contract, okay? Either selling or buying. So if you own physical certified coffee, then you can sell a future and deliver your certs for that. Or if you buy a future, you can hold on to it and accept delivery of certified coffee. This is important because it keeps the futures price real with the physical price. They have a correlation because of this mechanism. So therefore, the supply of certified inventory is going to be particularly useful for us to determine what is the fair value of the price of coffee, and especially the futures market. How do we get certified coffee? It's certified by the exchange. So trade house or whoever has the infrastructure to deliver coffee to the exchange to get it certified submits it. It passes a standardized inspection process, and then it forms part of the certified inventory. Now we have our ICE US market that does Arabica. We have our ICE Europe market that does Robusta, and they each have different looking reports. If you go to the ICE website and download it, this is what the Arabica cert stocks report looks like, and this is what the London report looks like. Now, we combine both of these into a single report in which our subscribers receive every morning so that they can look simultaneously at the Arabica and Robusta changes. And they can also look at the combined certified inventory levels to see, okay, what's the total amount of Arabica and Robusta certified stocks, and how is that changing over time? And you can see that here. So how do we read certified stocks? Well, much like the destination stocks, we're going to start with the data. We're going to look at the numbers first. What are the key numbers? Total inventory levels, that's key. What is the day-to-day change? That's important because it's going to help give us the momentum of the inventory. And then pending. The pending stocks has been extremely important over the last couple of years, right? Why? Because as you can see here from our 5-year chart, if this were a 30-year chart, it would look even more impressive because certified inventory levels got below 400,000 bags and were at 20+ year lows, right? So what happened to prices at that time? Naturally, they were very high. We had coffee up above 200 cents. We had inverted calendar spreads, as one of our members here mentioned. So we were very concerned about the absolute level, the total number of bags of certified stocks. Then appearing on the exchange was several 100,000 bags of pending stocks. So what does that mean? That means that we have a whole lot of inventory that is about to become supply, right? It's going to become certified supply. Now, we don't know exactly how much of that will pass and become certified stock. So that's why we have to pay attention to the pass rate. So initially, these had very good pass rates. We're passing somewhere like 70, 80%, sometimes 90% of the stock that was put up to the exchange was actually passing and moving into the certified inventory. Now, when we look at 300,000 bags of pending stocks with a 70% pass rate, then we can say, okay, now we can project forward what certified inventories will be. And remember, stocks is going to help us to predict price. So if we can project what the certified inventory will be, then we can project what prices will be. And that's exactly what happened. People started looking at that pending inventory, looking at the pass rate, and therefore making judgments on the price of coffee and buying and selling and trading it accordingly. Now, more recently, that pass rate has declined and it's moved the other way. Now it's more like 30% pass rate. So now people are becoming concerned again. They're saying, oh, actually, this 100,000 bags, even though there's 100,000 bags pending to become a new certified inventory, the pass rate is very low. So we are doubting that much of this is actually going to acquire into become new inventory. All right. So we know that stocks will help us to predict price, but a stocks to use ratio will actually help us to predict price even more accurately than stocks alone. So the stocks help us to predict price because they have an inverse relationship with price. And a stocks to use ratio also has an inverse relationship with price. So a stocks to use ratio is very simple. It's just your total number of stocks divided by annual demand. All right. Total number of stocks divided by annual demand. Now, the benefit of this is that we convert that supply and demand curve into a single number. When we can convert it into a single number, then we can actually plot it on a graph here. So this green line here is the stocks to use ratio. And you'll see that that has an inverse relationship with price. The red here is the price. So when stocks to use ratio increases, prices decrease. When the stocks to use ratio decreases, prices increase. Okay. And that relationship holds very well over time. And it's one of the key features in our price model. So we know that stock expectations equal price expectations. And that's why we care so much about what's going on in stocks and why we have all these different stock reports. Our price model, and this is something you'll find in our market report that we cover later, is generated from a stocks to use ratio. So here's our price model here, this green line. And all that is, it's a formula where we say, we're going to input stocks, we're going to input demand, and it's going to output a fair value. It's going to output a price. And this is how we can project forward what we think prices is going to be, because we project what stocks will be, and that helps us to project what prices will be. Now, one thing I want to point your attention to here is that prices often overshoot this model. The green line here is our price model. The black line is the actual monthly average price of coffee. So sometimes this follows very closely. It tracks very nicely with our model, right? And the trend is generally the same. It's generally correct. When the model is projecting prices to increase, prices increase. When the model is projecting prices to decrease, prices decrease. But we get these big overshooting periods here. Now, why is that? We contend that it's because of the spec. Now, don't get me wrong. This is not the saying the spec is doing something bad or undesirable. They're actually a very important and useful part of the market. But the commercials are trading the fundamentals, right? They're They are the supply and the demand. So the spec is able to meet in between the supply and demand. They enable the commercials, the roasters to buy when prices are cheap, and they enable the producers to sell when prices are expensive, because they always take the other side of the commercial position. But what ends up happening is this pushes prices above and beyond or below the value that we would expect from supply and demand. Now, we can tell this by looking at the COT report. The Commitment of Traders report shows the positions of all the different market participants, but in general, we're concerned with primarily two: the spec and the commercials, okay? And they always take opposite sides. This is something you'll see when you look at the COT report, is that when the commercials are long, the spec is short. When the commercials are short, the spec is long. This is what the report looks like here if you download it from the CFTC's website. We take it and we convert it into this format here so that we can provide some additional context and make the most important numbers easy to find and easy to pull out. So we mentioned this difference from the price model, right? If the fundamentals are driving this green line here, the specs are driving these extenuated highs and lows. Now, here's something from the second page of our COT report that shows just how important the specs are. Over the last 6 months, there was a 9% correlation between the spec position and price. That means if we can predict what the spec is going to do, we can predict 99% of what prices are going to do. Now, it's not always that high of a correlation, right? You can see over the last 6 months, it's been 99%, but over the last 5 years, it was more like 68%. So this correlation fluctuates, it changes over time, but it's a very clear and robust correlation. So this is what the front page of our report looks like here. We mentioned the different groups. So we've got commercials, we have swap dealers, we have managed money or speculators, okay? Now, not only do we have the different groups, but we also divide them into longs and shorts. So you can see the longs here. We have commercial longs, we have swap longs, we have managed money longs, and we also have shorts. We have commercial shorts, we have managed money shorts, and we have net, which is the longs minus the shorts. Now, in the case of the managed money positions, those can be the same. They can be both long and short at the same time, right? And maybe the same entities. But the commercials are usually different entities. So you might have the commercial longs are generally considered to be roasters, and the commercial shorts are generally considered to be trade, who serve as a proxy for the producer by selling futures for them as they sell their coffee to the exporters. Now, the absolute number here is important, but equally important is the momentum. And that's why we have our dates here. We can see not only what is the positions today, but what was it recently? And that is going to help us to find the change, and specifically the change in the spec position, okay? So here you can see what the total number of speculators are at this point in time. This was from back in May of 2021. The specs were still long at that point, right? So they had 58,000 longs minus 17,000 shorts. And so their net position was 40,000. But you can see here that position has been changing over time. It was getting longer and longer at that point in time. Now, we said we want to anticipate what the spec is going to do, right? Because that spec position is going to have a heavy impact on price. There's two primary ways that we try to interpret the specs moves. We look at the min-max and we look at vulnerable positions. So let's look at the min-max first. This is something from the second page of our COT report here. You can see each of these different categories that we talked about here. These are the commercials on the left and the speculators on the right. We have our longs and we have our shorts and we have our net positions. So these are seasonal charts, which means every year the position is overlaid over the previous ones. We can see our averages there, but we can also see the highs. These were the high points of commercial positions. These are the high points of spec positions and the lows. So how can we use this information? Well, at this point in time in 2022, you can see that the spec long reached the max, right? This isn't a hard and fast number. It's not like the spec isn't allowed to buy anymore once they reach their max position. We're just looking at recent levels that once the spec reached those high levels, there was not more money to buy more coffee. There was not more money to invest in trading coffee. And we can see here very clearly that we reached similarly high levels. And I think this is 2016 here, but I could be wrong. And so when the spec reached those highs that they'd already reached, they ended up selling off. There was no one else to buy. So they reached that max position and they ended up selling off. Now, similarly, the spec shorts were functionally at zero for almost an entire year. Now, when the spec shorts were at zero here, that meant that we could not force those specs to short cover, right? We've been seeing some short covering more recently, but they were already at zero at this point, so we couldn't force any of them out. In fact, the only way they could go was up, and that's exactly what happened towards the end of last year. We started to see those spec shorts increase. Now, when the spec does put on positions, then they become vulnerable. Unlike the commercials, the specs are not hedging, right? I don't know why they call them hedge funds, because they do the exact opposite of hedging. They put on speculative positions, right? So when a commercial has a future on, if a trade house has a lot of short futures, that is against physicals. So if the futures make or lose money, the commercial does not really care. It's not entirely true. There's some margin stuff, but we're not going to talk about that right now. But for the most part, they don't really care, because if they're making money on their hedge, they're losing money on their physical. They're making money on their physical, they're losing money on their hedge. The spec, by contrast, their entire fortune is tied up in their position. So that means if they put on a long position and the market goes against them, they can be forced to liquidate. So a new position is a vulnerable position for a spec. Now we can see that recently here. This was something I wrote in one of my recent COT analyses that I put out online. You can see here over the last 3 weeks, the gross managed money short position has been increasing. So the spec shorts have been adding. They've been getting shorter in 2 big tranches here, one of 10,000 lots and one of 20,000 lots. The first tranche they put on between 168 and 150. These are the levels that they went short. And then the second tranche was between 150 and 145. Now, what you can see here is that prices actually have been increasing since then. So what does that mean? It means all of these positions are now underwater. They are losing money. And if the spec is losing money on their positions, they cannot hold that forever. So they will be forced to liquidate. That is short covering, and it will force buying. So we can look at our recent positionings. We can apply what that cost basis was for that spec, and we can try to anticipate, hey, they're going to be forced to short cover here. If they're long, then hey, they might be forced to liquidate their longs. So those are our data reports that we covered here. There's many other data reports as well, but we talked about stock reports in particular, the destination stocks and the certified stocks, how both of these are super important. Why? Because they help us to anticipate price, right? And we also talked about the COT and how the spec can actually extenuate the price moves beyond what the fundamentals might imply. When we look at our reports here, we're going to get additional context through our charts, through comparing them to other numbers. But we always want to remember to focus on the data, right? It's not the context that's important, it's the numbers that are important. And then we can apply our own context and connect different data to other data. All right, so we made it through our intro. We made it through our data reports. Joe, why don't you check that one off? All right, thank you, Joe. All right, and now we're going to talk about analysis reports. So what are analysis reports? Analysis reports present conclusions. Okay, so that's what we're looking for. That's what a good analysis report does. It presents conclusions from the data. They're going to take the data, they're going to apply methodology to it, and that is going to let them get a conclusion or let them draw a conclusion. Now, something important and something I'm going to say several times here is that analysts are not an authority. You should never look at an analyst report and say to your friend, hey, Joe's bullish, Ryan's bearish. No one cares, right? Or at least the market doesn't care. What you should say is, hey, Ryan had pointed out that the stocks are decreasing and there's no other supply available, right? That can lead you to be bullish, but we want to look at their conclusions and how they're drawing them, but we don't want to use them as a black box. We don't want to say, oh, this analyst says that they're bullish or bearish. No, the analyst is not an authority. The analyst provides a service. So what do we mean by analysis as a service? An analyst is going to acquire data. They're going to collate data for you. They're going to apply a consistent, rigorous methodology to that data. And hopefully they're going to draw some insightful conclusions. That's a service. That is value because they're putting in labor. Some of the best analysts, some of the ones out there that we respect the most, they are good communicators. They recognize exceptions. That's why experienced analysts are valuable, right? We don't, new analysts are great, but we also want people who've been around the block for a while, been around 10, 20, 30 years, because they're going to be able to recognize exceptions. They might say, hey, even though there's this weather phenomenon in Brazil, there's a frost in this region, we know through talking to people and through being around for a while that, hey, the coffee farms in that region have actually moved north, so there's not a lot of coffee there anymore. So when we see a frost in that region now, it's going to be less impactful, okay? And they're also going to draw insightful conclusions. So the good analysts have a lot of different connections. They've seen the way things interact over many years. So they're going to be able to maybe draw conclusions that you hadn't thought of. So that's why we might want to use an analyst. Now, how do we read analysis reports? We're going to start with the conclusion first, right? Remember being goal-oriented. So we're going to look at what their conclusion is. And that might be, hey, something exciting is going on. Or it could be, hey, stuff's boring right now. There's not a lot happening. And that's totally fine. And in fact, that's a real service that your analyst does for you if they tell you that everything's boring, right? Because the market is not always exciting. Volatility is not always happening. And we should value analysts who say, hey, I've looked at the data. There is not a lot of there right now. There's not a lot going on. And that's going to save us time and effort. We're still going to want to evaluate that critically and such, but it's useful to know that things might be dull or slow. Now we can contrast that with analysts, who I'm sure we've seen plenty of these, who are always telling you that the sky is falling, right? They're excited and attracted to drama, and it's nice because it, sells lots of reports and people get excited and they want to hear about, exciting things. But the problem with this is this analyst is trying to just attract attention to themselves. They're trying to make themselves indispensable. And we don't think that analysts are indispensable. We think analysts are an important part of the supply chain. They're an important part of our group here, but they provide a service and they are not an authority. So we want to think critically about the methodology that the analyst is using. We're going to verify not only their method, we're going to verify not only how they're drawing conclusions, but also the data itself. Now, one thing that's going on in the current market right now, in current events, which you may have noticed, is that there are differing trade houses, differing analysts with different views on the Brazil crop, right? It's a little controversial, but I happen to respect all of the participants right now. I know of one example where there's let's just say two different groups. One camp thinks there's a very big crop in Brazil. Another camp thinks there's a very small crop in Brazil. Both of them have good data, right? They both have people on the ground. They have experienced agronomists there looking at that information. They also both have experienced high quality analysts evaluating that information. And yet we have two completely different views. Now, this means that we have to, this is where having an informed view comes in, right? You don't want to just be political about it and say, well, I believe this person, I like them more. We then need to verify the data, right? So why are they saying that the crop is good, or is it bad? Is it because of flowerings? Did they do surveys of the blooms? Is it because of planted area? We can evaluate how they're drawing these different conclusions that have such a huge impact on the conclusion. Now, our market report, the one that we deliver to our premium clients, our conclusion is fair value. That's what we try to provide our customers here. And so you can see this table is in all of our market reports right at the front. Now, what is fair value? Fair value is value that I can account for. So these are in cents per pound. This is not the most recent one. This is just an example table here. But our methodology is to divide the fair value into these 6 categories: fundamentals, macroeconomic environment, positioning, seasonality, technicals, and the weather, and assign a cents per pound valuation to each of them. So the fundamentals here, that's derived from our price model, which we saw is in turn derived from stocks and stocks to use ratios. That gives us a cents per pound fair value valuation. Then we apply to that, we use regressions for each of these different categories here to get cents per pound impacts to deviate from that valuation. So here you can see our price model here. That's the base. And then we move forward our projections either up or down based on the impact of these other categories. Now, price, the actual price, is going to fluctuate around fair value. It's not going to stay at fair value. So here, the gray boxes, this is where we estimate fair value to be. This is one standard deviation on either side of fair value. So if the prices are within those boxes, it's pretty close to fair value, and we would expect some kind of volatility in there. If prices are way up here in the green, this is 1 and 2 standard deviations above fair value, then we would consider that to be a selling opportunity. We would say coffee's overvalued. We know it's high, but we can't account for any of the value there. It is for reasons that don't seem based in any of this logic. Or if prices are very low in the red boxes here, then that says coffee is undervalued. That would be a buy opportunity. Now, we accompany this with an explanation. We have an email report that's presented hierarchically with different headers and sections that says, hey, the macro says this, the fundamentals say that. Now, we want to think critically when we are looking at these analyst reports and when we're evaluating them. We always want to challenge parts of them that we disagree with. That's the point of thinking critically about them. For example, let's say at this point in time, we had said, hey, we were very bullish the US dollar, and we think that's going to have a bearish impact on coffee prices. This was a while ago. But you might have looked at that and say, you know what, I'm not sure. Why does Ryan say that? So you can go to our report here. You look at the macro section, you pull up that relevant slide. You can see what our summary of this current situation is and what we were projecting. What was the data that we were using to support that? And if you wanted, you could check out the pros, the email that had a bit more context, information on why we had that particular view. And perhaps you disagreed with that. Maybe you said, you know what, I don't think that that's correct. Probably more like maybe you're bearish the US dollar at that time, and you think there's going to be a bullish impact on coffee. So you can literally just cross out that line and write in your own estimation there. And that's why we believe that a robust analysis is transparent analysis. And that's why we put everything in this table here. So it's very clean and clear and obvious exactly what we believe, to what degree, and we support that with why. All right, so we covered our intro, we covered our data reports, and we just covered analysis. Joe, why don't you check that off for us? All right, thank you, Joe. Now it is time for our conclusion and for our free gift to everybody that we've been looking forward to giving away here. But before we do that, we do need to get to our price here, which is our survey, our 3-question survey. Now, this should only take about 30 seconds to fill out here. Maybe we'll give you 1 minute. So Igor is going to put in the chat there the survey for you. And as soon as you finish filling that out, we are going to give you our free gift that's in the mystery box that only the people in this webinar are going to actually get. And we will finish up with our conclusion. All right, we've got about 30 more seconds here. We want to know what you think. Please fill that out. All right, while you're getting that filled out, we're going to move on to the next slide. All right, so what's our conclusion? First of all, analysts are not magicians. Magicians undermine your decision-making process. We don't want to look at our analysts as a black box that we can't see anything out of, that we can't understand how they came up with their bullish or bearish, logic. Instead, analysts perform a service, and a valuable service. If you have analysts in your organization, you should value them. If you subscribe to analysts or support analysts, we highly encourage that because we think analysts are very important. They perform a valuable service. That service is to organize, vet, and present information to make it easily consumable to traders, to consumers, and to producers to make informed decisions. Okay. And your analysts are also going to draw insightful conclusions, or at least we hope they will. And that's going to be something that's going to help you to be able to make your own good conclusions later on. So you can follow along with their process and see how they do their work. But always remember that the analysts are there to inform your view, not replace it. You never want to have as your logic, hey, so-and-so is bearish, therefore I'm bearish. Instead, look at their methodology and look at the data that they cited. And this is how we think you're going to have an informed view. And if you have an informed view, then you are valuable and you're going to be a valuable member of the team. But more importantly, you're going to be able to make informed decisions. An informed view is based on data. If you need reports, we have data reports available for free online. You can sign up here. You can actually check exactly which reports you want to receive. Again, it's all free. And you want to think critically about analysis. When you receive analysis, whether internally from your own organization or from a paid subscription like ours or any of our friends out there who are also analysts, we never want to look at them as an authority. We want to think critically about how they're doing it. And that means looking at that with transparency, right? Seeing what are the different reasons that they're using, what's the different data that they're using to support their conclusion. If you like our process, if you like the way that we think about analyzing the coffee market, we would encourage you to sign up for a free trial. We not only provide those market reports and weather reports and stuff that we just talked about, but we also provide a video recap. So every week we show a video that talks about all the different factors going on in the market. And now it's time for your free gift. All right. For the next 15 minutes, we are giving a special coupon for an extra month off. So this is something we've never actually done before. We typically give a free month trial for all of our premium content. But if you sign up over the next 15 minutes, we'll give you an extra free month. So you'll actually get 2 months where you'll have to pay absolutely nothing to evaluate our service. All right. So we covered intro. We went into data reports. We talked about analysis reports and how to think critically about them. All right, Joe. Thank you. And Joe just knocked out our last agenda item there. So with that, we can move on to questions. You can use the Q&A button on the bottom of your screen to ask questions. We'll take a few minutes here for questions. Looks like we only have a few minutes left, so we're going to be kind of quick. Or if there's other reports that you wanted to learn about, we can see if we can talk about those a little bit. All right, let's see what we got here. All right. All right, here's an easy one. Why is Arabica called KC? What does KC stand for? The KC comes from, it's just the code that the exchange uses to differentiate them. I think the C's were already taken by Cocoa. So they had to use the next one, which was KC, which is still kind of, coffee sounding. But you may have heard that referred to as the C market. And that used to stand for Centrals, right? Central American coffee, because it was only washed milds that were allowed to be certified by the exchange. Now, this has become pretty important lately. Why? Because of the washed Brazils, right? Maybe 5 or 6 years ago, the exchange started to allow semi-washed Brazils to be certified. So when that happened, it was initially not such a big deal, although people were kind of concerned about it at the time. But this became more of a big deal after 2020, when we had a very big Brazil crop and we saw a huge influx of washed Brazils to the exchange. And then the certified inventory changed its composition from primarily a Centrals Honduras heavy contract to a Brazil heavy contract. Now, this has become a little bit controversial lately because when we were trying to solve this crisis of low certified inventory, it was theorized that there might be unwashed Brazilian coffee mixed in with the washed coffees that was being certified, and it was theorized that that is the only possible way that it could be affordable enough to certify to the exchange. All right, so hopefully that answers your question there. Can we receive the link to the webinar so we can watch again? Yes. We will be posting this whole video on YouTube, so feel free to subscribe or check that out, and we'll post that as well. Okay, where to find spot market prices for Arabica coffee? That's a great question, and there's a lot of there's not a single answer for this. So the ICO does publish spot prices for coffee, and one of the reports that we publish is the ICO diffs report. In our ICO diffs report, we show not only what are the ICO spot prices, but also what are differentials, and we imply that by subtracting the futures market from them. Now, this is a little bit not 100% accurate, we can say, because these are derived from surveys. And instead of surveyed, we don't buy coffee with a survey, right? You have to actually do business in order for that to get an actual price. So a better way of getting prices might be a price list. So you would have to actually see vendors and see what they're selling, and then collate the information from vendors. But even if you do that, those prices are often just considered a idea. They're a price idea. And so there's no real price until business is done. So there's a lot of layers to that question, but those are some of the resources there. Okay, what do we cover on the coffee course in April? The coffee course covers 5 topics. We start with commodity markets in general, and then we move on to coffee fundamentals. We spend a day on technical analysis. We spend a day on derivatives and talking about the various kinds of derivative instruments. And then the 5th day is on price risk planning. And that's where we put all of that information together. And we talk about how to create a hedging plan or a trading plan, and how to make good business decisions in the market. All right, I think we have time for maybe one more question. Where can, let's see. Why is the coffee price high compared to low price on the New York Exchange? Okay, good question. I'll start by saying that the coffee price doesn't have to answer to anybody, right? So I'm going to give you my view on why coffee prices are what they are. But the real answer is because that's what people are paying for it, right? People are buying and they're selling those futures lots, and the supply and demand is determining the price. Now, as you saw in my analysis there, I attribute an idea of fair value. So I say this much of the coffee price is based on this much is based on that. A big portion of coffee prices when they were high, when they were above 200 cents, was from the spec long position. We had a spec that was very bullish and they were all engaged on the long side. And starting in about November of last year, that transitioned. Those spec longs started getting out and the spec shorts started to get in. So in my view, although there are fundamental reasons why the prices have come down, the futures market has been extenuated by that spec movement. And so that liquidation of the spec long and the transition to the spec short has exasperated or extenuated the move to the downside. Furthermore, calendar spreads, which we didn't cover in this particular webinar, went from being very much inverted because of the very low certified inventory. And that incentivizes specs to stay long and be long. And that changed. As the certified inventory rose, calendar spreads have come off. They're actually back in contango now, or at least they were as of last time I checked a few hours ago. And so that disincentivizes specs from being long and incentivizes them to be short. So that was a big factor. Now, which coffee prices are you talking about here? Colombian coffee, Brazil coffee, Central American. A lot of these are high and they're all related, but they have some different reasons. So the Colombian coffee prices have been very high because they've had 2 years of terrible weather in Colombia. That it's been very much overly wet. And we're gonna do some deep dives into the Colombian market very soon, both in our blogs and also in the podcast. So the lack of supply from reduced production in Colombia is been creating high Colombian coffee prices, and that has a knockoff effect throughout all of the other washed milds, because the Colombians are the largest producer of Central American type washed coffees. So Guats and Hondurans and Nicks and Sals, those are all sort of somewhat replaceable, not exactly. They all have their own unique characteristics, but somewhat replaceable in the same kind of market as Colombians. So when the price of Colombians goes up, that pushes up the prices of all of those, and there are other factors going on. And finally, Brazil, that is a whole other ball of wax, as they say. There's some big things going on there. Some people say the crop is small. The crop is much smaller than anybody says, and that's why diffs are high. Other people say, no, the crop was not super small. What actually happened is that the Brazilians got lots of money because prices were very high for selling their coffee, so they can afford to sit back and wait. So they're stepped back away from the market and not selling, and that's why differentials are high. And still others are saying that because we had a poor crop in Brazil, the Brazilian farmers have defaulted their commitments to exporters. And so those exporters now have to buy up coffee that they thought they had bought before, which is pushing up internal prices. So that's my thoughts on coffee prices there. All right, everybody, that's all the time we have now for questions. Thank you so much. Now, remember, you got 15 minutes here. So thank you again for joining. If you do want that extra month, the clock is ticking here. So you don't have much time left. So go sign up if you want your free month. Thank you all again so much for joining. All right.